since I kind of discovered that everything code thesis about liquidity being the dominant driver, I realized there's one macro driver that drives everything. And then on top of it is the adoption of technology, whether it's crypto or tech. Those are the two mega trends. Nothing else outperforms the debasement of currency, which is 8% a year plus 3% inflation. So 11% a year is what you need to do to break even on your savings. And so you've only got two assets to do it, technology and crypto. When I divide the NASDAQ by Bitcoin, it's down 99.97% since 2012. Every time horizon, it's underperformed, but they're driven by the same fact.
In today's financial world, one powerful yet often overlooked force quietly drives markets, economies, and investor behavior: liquidity. It's not company earnings, economic reports, or political events that move markets the most, it's the amount of money flowing through the system. When liquidity rises, almost everything benefits. Stocks climb, credit becomes more accessible, and riskier assets like cryptocurrencies tend to rally. Conversely, when liquidity dries up, markets can plunge swiftly. Understanding this flow of capital isn't just helpful, it's essential. Few understand this better than macro investor Raoul Pal, who argues that we're not just facing a new market environment, but entering an entirely new era he calls the exponential age. This era is defined by rapid technological growth that's transforming market behavior and how wealth is created. Unlike gradual or predictable change, this transformation follows an exponential curve, accelerating faster over time. Technologies like artificial intelligence, robotics, cryptocurrencies, biotechnology, and clean energy are not only advancing, they're advancing at an increasingly rapid pace. According to Pal, traditional tools like investing models and government policies, designed for a slower, more linear world, can't keep up with this acceleration. Traditional assets such as bonds and blue-chip stocks often lag behind. That's why Pal focuses on what he calls exponential assets, Bitcoin, Ethereum, and other emerging technologies. These assets benefit from network effects, meaning their value grows as more people adopt them, and they offer asymmetric returns, where the upside far outweighs the downside. Unlike traditional investments, their value isn't based on steady profits or dividends but on adoption speed, scarcity, and available global liquidity. In other words, they thrive in environments fueled by rapid growth and easy money. Pal recently discussed these ideas in an interview with Mohammed Rasool, CEO of Amana.
To explain the exponential age, it's this extreme exponential adoption of these technologies, whether it's AI, whether it's crypto, whether it's EV, whether it's robotics, whether it's space, all of these things. And they are all on a log return. So they're exponential if you look at price charts. So that is the game we're playing. Those exponential assets, if you think of Amazon stock, back in the early 2000s, it fell 97%, it went up 600%, it fell 50%, they're volatile.
Yeah.
So they're volatile assets, but if you can hold on to them, the returns are truly extraordinary. This is why Jeff Bezos is the richest man in the world, or close to it. And, it's all the same thing. So that is the mega trend. That's the exponential age. Within it, you have the business cycle and the liquidity cycle that drives this. So what you find is you need to understand where you are in that cycle. That cycle is driven by liquidity flows, let's say. And recently we had liquidity tightening from a strong dollar and higher rates in Q4 2024. That has a 12-week lead into assets. So assets fell because liquidity had tightened then. Liquidity has been doing the opposite now. It's been easing massively. And so price should follow. But the volatility is big, right? People don't realize is, you're used to a 10% being a correction in the S&P and anything above 20% is a bear market. 20% is an afternoon in crypto because it's highly volatile. It's a 70 vol asset versus a 15 vol asset. So it's much more volatile. So the idea is you need to be able to understand how to navigate the volatility. So what we call the banana zone, what is that? That's the accelerated point in the cycle where prices go exponential. It's usually at the latter point of the business cycle. And that's the kind of zone we started. We had the big leg up Q4 last year. We've had a corrective period, and then usually we now should go up for the rest of the year in a way that makes it quite hard to even buy, with a couple of sharp corrections en route just to gut check everything.
Yeah. With the unknowns that'll come in through.
So now we've established that we're in this exponential trend that is driven by the business cycle. It's a 4-year cycle driven by the debt refi cycle. We're in the last year of that, which is usually one of the best parts of the entire cycle. It is going to be volatile throughout that period. So then my job is trying to communicate to people, okay, if you've been given the greatest performing asset of all time, then you don't want to screw it up.
Yeah.
And it's hard because most people aren't used to volatility. It becomes emotion.
Introducing the all-new Ledger Flex. Your next level crypto wallet is here. Sleek, premium, powerful. The Ledger Flex delivers a solid high-end feel with smooth edges for a more comfortable grip, and that satisfying nostalgic sound you didn't know you missed. Still clicking away in your old Nano S? It's time to upgrade and lock in your crypto gains with style this bull run. Smooth, modern design built for serious profit. Click the link below to grab your exclusive Ledger Flex. Ditch the rest, go Ledger Flex.
And emotion doesn't help you in this. It'll force you to do the wrong things. So I try and explain to people, firstly, don't use leverage. It always looks great because you see some guy on Twitter who's made 100x returns and he's done it in perps and he's done it. It's like, it's never going to happen. You are going to lose your money. Because rule number one is don't lose control of your tokens. Because really, you want to hold it from here and you want to be Jeff Bezos here, right? And he didn't lose control of his equity. You don't lose control of your tokens. So that's really vital. It's also, don't FOMO, because you'll find out you'll end up buying at peaks and selling at troughs. That's the emotional side of things. Also expect 30 to 40% pullbacks often and think of them as normal. And if you've got cash, that's when you buy more stuff. So it's like having this mentality. It's also be careful not to lose your tokens because you get hacked. So store them on a ledger system somewhere.
Yeah.
Keep a cold wallet. Just simple things like that will stop you losing your tokens. Stop you, even you FOMOing in fear, selling out, panicking, or bull market buying too much. If you don't do that, you'll lose control of your tokens. Again, just don't lose your tokens.
The basics.
And just hold it from here. And in 5 years' time, it'll be here. And in 10 years' time, it'll be here. And people don't believe that's possible. But this is the gift that keeps on giving it. It's the same with NASDAQ.
Yeah.
Right? Tomorrow will be more digital than today. It's a simple fact. So will tech stocks over time do well? And everyone goes, yeah, but they crashed in 2000.
Right.
Okay, well, we had a massive bubble in tech stocks then. You pay back for a year or two, but anything you bought into that crash was Amazon, Google, Apple, all of these things did stunningly well. So people just have the fear of what's happened in the past. But we know this tech adoption curve is not going to stop. In fact, it's increasing. So the probability is, even if you have a bear market, which we had in 2022, it lasted 1 year, 9 months. 9 months, it bottomed out with liquidity, and it's been up ever since.
Raoul Pal challenges the traditional idea of asset diversification, especially amid the macro and technological changes happening in what he calls the exponential age. While classic investment theory promotes spreading risk across stocks, bonds, real estate, and commodities, Pal argues this approach is becoming outdated. In a world where most assets move in sync with global liquidity, traditional asset classes tend to behave similarly during periods of monetary expansion or tightening. When central banks inject liquidity, nearly all assets, from stocks and bonds to real estate and even art, rise together, and when liquidity contracts, they fall together. This correlation undermines the basic principle of diversification, which assumes that when one asset class falls, another will rise. According to Pal, true diversification today means owning assets that perform differently across liquidity cycles. This is where exponential assets like Bitcoin and Ethereum become crucial. Pal sees crypto not merely as another risky asset, but as an entirely new asset class with unique characteristics: reflexivity, adoption-driven growth, and structural scarcity. He has openly stated that he is irresponsibly long on crypto, not because he dismisses diversification altogether, but because he believes these assets offer asymmetric upside potential that traditional investments can't match. Unlike conventional assets, cryptocurrencies don't just move independently in terms of volatility, they are fundamentally different in how they generate value. With this framework in mind, let's dive back into the discussion and examine how Pal's views on diversification are being challenged and tested in today's market.
The wrong person to talk to about diversification. Because I've run large diversified portfolios, big hedge fund portfolios with many, many positions. And what I found is, since I kind of discovered that everything code thesis, about liquidity being the dominant driver, I realized there's one macro driver that drives everything. And then on top of it is the adoption of technology, whether it's crypto or tech. Those are the two mega trends. Nothing else outperforms the debasement of currency, which is 8% a year plus 3% inflation. So 11% a year is what you need to do to break even on your savings. And so you've only got two assets to do it, technology and crypto. When I divide the NASDAQ by Bitcoin, it's down 99.97% since 2012. On every time horizon, it's underperformed. But they're driven by the same factor. 97.5% of the price moves of the NASDAQ are explained by global liquidity and 90% of Bitcoin. Yet, the performance is so wildly different. So I don't even know any tech stocks. Yes, I have trade recommendations for people who do, etc. I don't know those. So now you've got the world of crypto. So then, if they're all being driven by the same thing, what you want to choose is the fastest horse. Now, that's not buying the meme coin that can go up 100x. What you're trying to do is look for what are meaningful projects being run by meaningful people with meaningful communities. So it's this Metcalfe's law idea, how many active users do they have? What kind of value are they creating?
The utility, if you will.
Yeah, well, it's the measurement of the entire utility of the network. Do people value the network? Do they want to build on it? Do they want to transact on it? Do they want to own it? And so there's not that many that really show this. You've seen some of the communities like Cardano has a huge amount of retail users, almost no applications. Bitcoin has both at scale. Ethereum has both at scale. Solana is earlier in the network adoption model, but it's got it at scale. Sui, arguably, very early, looks like it might get it. So then I played the dumb idiot. I kind of have a thesis in my head, and I'm just like, what does the chart look like? And so you start with the chart of Bitcoin. That's your benchmark. Is the asset that you think is the greatest asset ever conceived, the one that you want to own, is it outperforming Bitcoin or not? 99% of all tokens don't. Okay, don't own them. But once you find the one that looks like it will, okay, now it's interesting. And that's what I had. That's why I switched from Bitcoin to Ethereum in the last cycle, then from Ethereum to Solana this cycle. Solana outperformed Bitcoin and outperformed Ethereum. And then halfway through the cycle, I realized the other horse in the race was going to be Sui, which was the ex-Facebook team built a blockchain, and I happened to be on the board of it, but it wasn't for that. It's because it was breaking out versus Solana, which was easily the strongest horse. I'm like, okay, this is the strongest horse squared. This is my bet.
Nice, interesting.
And so I'm pragmatic, because as you say, we don't know what will survive and what will do well. So I'm just pragmatically looking at kind of weekly chart time horizons.
Performance quite a bit.
Is it breaking properly? Have I got something to capture in understanding how it's going to move going forwards? I'm not interested in day-by-day stuff. Is it structurally looking like it's going to outperform? If it is, I'm going to hyper-concentrate, because then I don't have to worry about anything else.
Bitcoin is making headlines again with a bold new prediction from Standard Chartered, a major global bank based in London. Their recent research, based on 13F filings that reveal institutional investment trends, shows growing interest in Bitcoin among a broader range of investors. Many institutions are gaining exposure indirectly by buying MicroStrategy stock, a company known for holding large amounts of Bitcoin, rather than purchasing the cryptocurrency outright. This shift comes as interest in Bitcoin ETFs like BlackRock's iShares Bitcoin Trust cooled in early 2025, while demand for MicroStrategy surged. Standard Chartered has doubled down on its forecast, predicting Bitcoin could reach $500,000 by January 2029. The bank believes that as more institutions adopt Bitcoin and its price becomes less volatile, portfolios will gradually increase their exposure, moving from underweight positions to what they call an optimal allocation. At the time of their report, Bitcoin was trading just above $110,000, showing steady gains and an increase in market dominance to 64.5%, signaling renewed investor confidence even in quieter markets. Futures data also indicate cautious optimism, with most recent liquidations occurring on short positions, suggesting bearish traders were caught off guard. With institutional interest expanding and price action remaining stable, Standard Chartered's long-term outlook paints a compelling picture of Bitcoin's potential. Adoption growth and decreasing volatility could drive Bitcoin to unprecedented highs. Regardless of whether it hits the $500,000 mark, it's clear that Bitcoin is no longer just a retail investor's asset. Wall Street is now deeply engaged. What do you think? Could Bitcoin really reach $500,000, or is Wall Street getting ahead of itself? Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.